Welcome back, everybody, to Disc Media, a startup story, the podcast where we take you behind the scenes of starting a business from the ground up. And today we have a very special guest joining us. Want to introduce to everybody Mr. Nate Littlewood. Nate is an entrepreneur, a founder, started a company called Urban Leaf, which I believe started off as a Kickstarter campaign and turned into a thriving company. Today, Nate is leading Future Ready CFO, and he is here today to share with us some of his insight, his wisdom, and the things that kind of got him started. So, Nate, how are you doing today?
I'm pretty good, Ben. Thanks for having us. It's great to be here.
Nate, I was mentioning to you before we got started, one of the things we like to do with this podcast is kind of take people on that journey of starting a business, from the ground up. And you've actually done a few things now. If you wouldn't mind, can you walk us through a little bit of your journey, what you've done previously, and then kind of what you're doing today?
Yeah, absolutely. So my focus these days, and I find it easiest to work backwards, but at the moment I'm working on a fractional CFO consulting business called Future Ready CFO. The term fractional in there basically means that I, work across a number of different startup businesses. These are all companies that are not large enough yet to justify having someone like me on board full time. But I basically help startup founders get clear with their numbers and finances and help them understand how to use finance and financial strategy to optimize the strategy, the growth, the profitability of the company, and ultimately, scale faster with more profits and less stress along the way. So been at this a couple of years. Prior to this, I bootstrapped my own e-commerce business, as you mentioned, from the back of a Kickstarter campaign into a seven-figure business. And there is nothing that really compares to the learning experience you get from, being in the driver's seat and building a company like brick by brick, square by square. Along the way, I also did some mentoring. I was actually a lead mentor for an accelerator program based here in New York called Food Future Co. That program is unfortunately no longer around. It's been disassembled, but we specialized in getting early stage food, bev, and ag tech businesses ready for their first round of institutional investment. So through that, had a lot of experience coaching and working with early stage founders. So all in all, I've been in the e-commerce / startup space for about a decade or so now, in one capacity or another. But prior to that, I spent about the first half of my career working on Wall Street at an investment bank. From Australia originally, as you may have already detected from the accent, but yeah, it's had about a decade-long career there, and that's essentially how I learned the world of finance. So basically, what I do now is take that deep finance experience with first-hand knowledge and understanding of what it's like to build a business like this, overlap them, and I'm now helping other founders with their finances and numbers.
One of the things I often talk about is how, your numbers in your business, especially as it relates to finance, also sales and just tracking those things. It is really the diet and exercise of your business, right? And just as you would never ignore those factors to keep yourself healthy, ignoring your numbers can lead you down some really bad paths.
Absolutely.
When you started this fractional CFO business, and this is something I'm finding that is being written about more and more these days, because CFOs can be kind of pricey. And so having a fractional CFO, somebody who can come in as needed to kind of oversee critical moments in business. Are you finding that this industry is starting to pick up more in that direction, especially for businesses who can't quite afford full-time CFO help?
Yeah, absolutely. Well, I mean, the concept of a fractional CFO, and you hear that fractional term, used with sales and operations these days as well. I mean, really what it is kind of a consultant or agency. And we've been using terms like consultant and agency for, decades when it comes to, helping start up businesses. To be totally honest, I don't really know why we've latched on to the term fractional here, but it seems to be the industry norm when we're talking about finance people. But yeah, I mean, it's, the fractional gig economy is, only picking up speed. I mean, in my space, which is, where obviously most of my focus is dedicated to, yeah, there's a lot of choices out there. There are more and more, every week and every month. But I think what is interesting about it is we're all unique and different in terms of our experiences and the way we approach things. There's plenty of people out there who offer a more traditional, very finance centric version of CFO support. That's not actually my brand of doing it. Like, that's not the approach that I take. The way that I tackle this is a little bit more like a co-founder on demand. I just happen to be the co-founder on demand who's really good with finances and numbers. So, I get in the weeds and in the trenches with my clients, and essentially help them untangle their most complicated business problems.
So let me ask you this then. When you talk about the space you're in, is there a particular industry or type of business you find that you fit the best with?
Yeah, I do. So I focus specifically on e-commerce and consumer packaged goods businesses.
Okay.
What all of my clients have in common is that they're investing in inventory, right? These are physical goods businesses. So they have to think about how to manufacture the inventory, move the inventory, finance the inventory, get the inventory to customer. Completely different risks and business model to, a technology, a software, a SaaS type business, right? So that's all I do. More specifically, I specialize in seven-ish figure businesses. These are typically companies with like 2 to 8 employees. And what I really enjoy about that space is you're kind of in the middle between post product market fit, right? If you've gotten to 7 figures and you've obviously got something that the world wants, people are buying it in significant quantities. So we've got some evidence of product market fit, but we haven't really grown into a mature, systemized, process oriented organization yet. We're kind of in that messy evolutionary phase between, hey, this was a cool idea, it's got some traction, I'm starting to put some money in the bank, and the next chapter of my story is I actually need to build tools and systems and processes if I'm going to scale this thing. I kind of love that gap between those 2 points, right? And helping founders, get set up for their future success and growth. That's really what I specialize in.
Coming from the CPG world myself, it can be really, really challenging. As a matter of fact, we had a couple of weeks ago a guest on that talked about financing in the world of CPG and kind of
Hmm.
creating finance options for that point where you have product, you sold it to a customer, maybe you're selling it into a larger chain customer. And
Hmm.
those deals are great because it puts your product in the presence of consumers and it brings more volume. The challenge is the pay doesn't necessarily your invoices don't necessarily get paid right away, right?
Yeah.
And so you've got to figure out like, okay, how do we sell, wait for payment, still create more product, buy more raw material, bring that in. And
Yeah.
so this is kind of the sweet spot you operate in.
Yes, it is. It is. And I hear you on the financing angle, and it's I mean, if I may, it actually gets a lot more complicated than what you just said. The other very common issue with those sort of agreements is the margins can be, incredibly thin. So not
Yeah.
only have you, outlaying cash for a long period of time, and not only can there be very lengthy delays between, until you get paid, which is effectively, an interest-free loan that you're giving to your customer. On top of that, the margins on these things are scarily thin. Some of these big distributors in the food industry, especially, I mean, they can, the chargebacks and trade spend and all the fees they charge you can easily rack up to like, 30, 35% of the top line. And so when you take away all their fees, you're left with very, very skinny profitability. Plus, you have to basically offer your customer an interest free loan, sometimes, 2 or 3 months into the future. And yeah, It's a tough industry.
It is a tough industry. Well, let me ask you this, because I sometimes joke about how I'm going to pick on Walmart here for a second, just because I think they're very good at this game. Like Walmart and Dollar General are very good at this, where before, I mean, as they're constructing the location, every product, from CPG product that is on the shelf, there's a slotting fee
Hmm.
involved. There are, if you're going to be on ad during the year, and these things are usually planned out months ahead, they're charging for placement in the ad. They're charging for placement in the store, placement on the end cap. And they're making a lot of, revenue before that product even gets sold, right?
Yeah, yeah,
And that's just for you to have the privilege of having presence in their store.
yeah.
With CPG companies today, and I guess maybe it depends on the product, but how much sense does it make to keep trying to chase brick and mortar placement versus trying to sell online and getting market penetration that way?
That is an incredibly complicated question. And so many directions we could go with it. I mean, it depends massively on the product and product category. Some products like beverages, for example, like they're heavy. If it's a heavy product, it's expensive to ship. So
Yeah.
your options to go through e-commerce might be quite limited. Other products and categories are just, not things that consumers are used to buying online. So you might not really have a choice, but to meet the customer where they're at, which happens to be on a grocery store shelf. It also depends a lot on, the financing of the business. Is this bootstrapped? Do they have millions of investor dollars behind them? As I suspect you know a lot better than most, like it can take millions and millions of dollars over many, many years of investment into some of these sales channels before you actually turn a profit and start getting cash coming back to you. The playbook that, I mean, it's not certainly not the only playbook, and not the one that we would always recommend, but a very common playbook I would recommend to founders is to, even if the market size is constrained and even if your volume is small, start off in e-commerce and direct to consumer. And the reason for that is because you need far less inventory, your margins are going to be better, you less regulated, less rules. It's easier to iterate. And the feedback loop, and this is probably the most important part, the feedback loop from the customer is so much shorter, right? If you deliver it to an e-commerce customer, you can get feedback a day later. You can take that feedback, you can iterate the product, change the packaging, change the serving size, do whatever it is you need to do. And you can ship a new version of the product like weeks or months later, right? You cannot iterate and evolve and change like that if you're on the shelves of Walmart, right? Walmart's just not going to take it. I often recommend to my founders that we at least focus initially on direct to consumer because we need the learning opportunity, we need the feedback, we need to nail the messaging and the value proposition. And once we've got a lot of this stuff figured out, then we can think about scaling through wholesale or retail relationships, but understand that that's going to be expensive. The margins are likely, depending on your product, but all else equal, the margins are probably going to be lower, and it's going to take a lot of time and a lot of money to do it.
You mentioned the beverage category. I have, in my background, I spent about 20 years at Coca-Cola, so I know that
You do know it better than
that
most then.
system pretty well.
Yeah.
One of the things that is challenging, especially in the beverage space, is it's really dominated by very few players. And
Mm.
so it's tough to get distribution
Hmm.
because you've really got to get on one of maybe two or three trucks to,
Right.
get into the store. And oftentimes, a lot of stores don't receive anything beverage wise that doesn't come in from one of those couple distributors that are already servicing them.
Mm.
And then to try and get on those trucks, of course, they've got to make space for you. And to your point, it just costs a ton of money
Yeah.
to do that. Which is, what's interesting is in the beverage space, we've seen a lot more kind of newer, smaller brands that have been, popping up. But even something like an Olipop has got a significant amount of money behind it to have gotten them where they are.
Yeah, yeah, absolutely. I mean, it's what you're alluding to here is basically the strategic value of owning distribution and sales and the route to market, right?
Yeah.
Like Amazon is the classic e-commerce equivalent to that, right? They control the customer relationships. They're, in the customer's inbox and on their phones every day. And they charge a pretty penny for it, right? It takes a long time and a lot of money to establish that, delivery mechanism, that route to market, the ability to put a product into a customer's hand. And unfortunately, whether we're talking about e-commerce or, retail brick and mortar, like those relationships are incredibly consolidated. It is scary how few players there are, not only manufacturing the products that most of us consume, but also distributing and shipping and controlling, like how they end up all over the country. So yeah, you're absolutely right. Like the people who control those relationships and control those pipes, if you will, of getting product around the country, like they charge a pretty penny for it.
And it used to be, and not too long ago. I mean, I've been in the CPG world for a little over 30 years now, which is crazy to think about. But one of the things that's interesting is, I would say, gosh, 10, 15 years ago, there was a lot less consolidation than there is today. And
Mm-hmm.
so those channels of distribution that you're mentioning, they've only gotten tighter because there's been many more distributors that have consolidated, and ones that are getting really big. And there's,
Yeah.
kind of a positive and negative to that. The positive, of course, is, better efficiency, faster throughput, et cetera, et cetera. The challenge is that when you're a small brand, regardless of what type of CPG brand you are, breaking through the noise now of a big distributor who has products that have better margins for them, that it's less challenging for their sales staff to sell that into customers. Like
Mm-hmm.
that to me seems to be like one of the bigger challenges in the CPG world right now is, a lot of this distribution consolidation.
Mm-hmm. Mm-hmm. Interesting.
So when you think about the things that you guys are doing today, what are some of the things that you're seeing as wise insight for those who might be considering engaging with folks like yourself? Like, what are some things that you like to see people prepared for to kind of engage with you?
Yeah, interesting question. I'm going to offer a couple of different answers to that. The first is in terms of your journey and evolution as a business owner and founder. In my experience, people tend not to come looking for someone like me until they've been in business for at least 2 or 3 years. It often takes that long to have experienced the pain of not understanding your finances.
Right.
You have, dealt with, some predatory lenders, or you've experienced stock outages, or you were selling a product in a sales channel or whatnot, and then subsequently realized that you lost hundreds of thousands of dollars because you didn't understand the margins and unit economics. So usually after being in business for at least 2 or 3 years, what I see is some portion of the founder population, they start to get frustrated by the financial outcomes that they're generating. Like entrepreneurship and running a business is not an easy job. And there's a lot of blood, sweat, and tears and hours that go into building these businesses. And if you're not generating the financial rewards that you want, that gets frustrating very, very quickly. And I see this in the form of, founders who aren't paying themselves enough. I see it in the form of founders who are not paying themselves consistently because they have to prioritize other things above their pay in terms of cash flow. And I see it in the form of founders who are, busting ass, working hard as ever, but there's never any money in the bank. And they're like, WTF, man, like, where did it all go? It just evaporated. I can't explain where all the money went. So that at that point is usually when they come looking for someone like me. When I start talking to a founder, I will pretty quickly try to put them into one of three buckets. The first bucket is what I call the product person. They might be a designer, a creator, subject matter expert. They're someone who understands, the products and the customers that they're in fairly well. The problem that I often see with these people is that they love product and product development so much that they've often got way too big a catalog, too many widgets, too many choices, and usually far too many choices needed to, in order to solve the customer problems, right? So when I work with people like that, I'm often looking at, the size of the catalog. I'm looking at metrics like revenue generated per SKU. Every SKU, every product has a cost to bring it to market. And if we're not generating enough revenue to justify that, then the entire, catalog, a lot of it just doesn't make sense. So that's category one. Category two is I would call the marketing wizards, right? So these are people who understand Meta, they understand Google, they understand cost per click advertising. And these people, as long as they understand the unit economics around customer acquisition, lifetime value, and that sort of thing, they're often quite happy to keep plodding along, making their whatever it is margin per order and kind of keep doing what they're doing. They're usually a lot less interested in product development, and they're much more focused on optimizing their Meta dashboard, for example. In my experience, they often not great customers for someone like me. I can talk more about why, but they're not ideal. The third profile, which is where most, if not all of my customers lie, is what I call the business owners. So these people are usually not expert in any one discipline or domain, like they know a little bit of everything, but they've been beaten up enough by their finances and the experience with the numbers that they know that they need help. And they're curious enough to want to learn about the finances. They want to understand the math behind their company. So these people have experienced a problem. They know that they're not expert in this area. They understand the implications of not understanding this stuff, and they're coachable. And they're usually the best type of customers for someone like me.
So when you think about that third group of people, and I think it's really good that you kind of know who you're going to be able to help out the most. And this is something I've actually talked about this on a few episodes before about how it really helps when you have people who want to learn, because
Yeah.
that is what just kind of makes the relationship a little bit easier when people have that position, like you've got to constantly try and prove that you know what you're talking about. Makes it very difficult because and not sure where that comes from in the way of people want to challenge. But thinking of
Mm.
that third group, and I'll leave it up to you as to whether or not you want to talk about anybody specific or not. But can you think of an example of a company, a group of people that you worked with, a product that you worked with, where you really had a significant impact coming in? They were open to
Mm-hmm.
learn, showed them some things that they weren't aware of, and just brought them to the next level.
Yeah, absolutely. So one of my current retainer clients, actually, I think is a great case study. I'm actually hoping to do a testimonial / case study with them fairly soon. But this is a husband and wife co-founder team, and they have a homewares business, and they've been at it for, I think, best part of a decade. Chugging along, doing fine, but really the business for most of its existence had really just been growing fairly slowly and organically, right? They'd never really put any time and attention into marketing, traffic, driving customer acquisition, and they didn't really understand where their website visitors were even coming from. But the numbers were ticking up, 5%, 10% growth year on year, and they were kind of chugging along. I started working with them nearly a year ago now, and one of the first things that we started exploring was media buying. So basically, pay-per-click advertising, i.e., driving traffic to their store with Meta and Google. Um, we did this after looking at their unit economics and understanding how much profit that they were making on every single order. We had also looked at the typical customer acquisition cost in their product category. And we thought, there's an interesting ratio here. Like, you guys are making quite a lot of money per order. And, it doesn't seem like it's going to cost anywhere near that to acquire each customer. So we need to go and find a media buying agency to help you, run ads. In that process, I helped, find and evaluate the agency. But a really interesting part of what we did here is actually structure an agreement with the agency where their performance or what they get paid is linked to how much profit they generate. One of the big problems with agencies like this is, they get their fixed monthly retainer, whatever, 4, 5, 10 grand, but they're really not that incentivized to drive outcomes for you. And, whether or not you're making or losing money, they're still getting paid their 7 or 8 grand a month. So, no skin off their back. So what we did here is quite intentionally structure an engagement where basically they get paid if we get paid. And the more money the business is making, the more money the agency makes, right? So that was one thing. Anyway, it's worked incredibly well. The business is now growing at about 100% year on year in terms of profitability. And we've also been working in the background here on what's called the cash conversion cycle. And the cash conversion cycle, for folks who may not be familiar, is essentially how long it takes your business to turn payments to vendors and suppliers into cash receipts from customers. Now, the quicker the cash conversion cycle is, the better. But the problem is with a lot of physical products companies, you have to order, thousands of units at a time. You have to pay your supplier up front. You're sitting on inventory for months and months and months. Then you sell it, and then sometime later the customer pays you. And these cash conversion cycles for a consumer products business can easily be 6, 9 months. I mean, I've even seen some businesses with over 12. What we're doing with this particular client, however, is we recognized an opportunity to move a lot of their procurement and buying of products to a platform called Fair, which is basically a marketplace for wholesale products. Now, Fair gives you 60-day interest-free payment terms. So they can receive a product and be able to sell it. They don't have to pay it for 60 days later. In addition to that, I've also lined up a financing solution for this customer, which adds an extra 60 days on the back of it. So this business can now order raw materials, take receipt of those raw materials, sell those raw materials, sell the finished goods to a customer, but they don't have to pay the supplier effectively till 4 months later. So what this means is we've got like this cash cycle where we can receive payment from our customer before we have to pay our supplier for the product. And this is usually only a cash conversion cycle situation that you see in marketplace businesses like Amazon. I mean, Amazon's a classic example of this, right? They receive your money immediately every time you buy something there, but they don't hand that money out to the vendors and suppliers until 2 weeks later. So Amazon also has, what we call a negative cash conversion cycle. But when you can set up your cash flow that way, you basically completely remove cash as a constraint and bottleneck to growth. And, the more you're growing, the more cash you're generating, and, puts a business in a, phenomenal position for scaling. So we haven't, fully executed that whole cash flow piece, and we're certainly not there yet, but I would expect within the next 3 to 6 months we get there. And that will be a pretty awesome outcome for these business owners.
That is really, really good. Something that a couple things there to unpack, but one of the things you mentioned was the organization that you got them to basically kind of grow with you. The incentive is, the better we do, the better you do. Which is a little bit unusual because a lot of times the people who do that work, they really do kind of just have their baseline, retainer. And of course, it can go up from there if you want to do more stuff. How was it that, was this a deal that you worked out just with them, or is this the way that they do business? Like, how did you get them to go along with that?
So The way I negotiated or I positioned it to the agency was essentially, look, we're generating X dollars profit without you. We don't need you to generate this X that we've already got coming in every month. So I don't want to really reward you for doing something that we're already doing by ourselves. If, however, you can help us achieve a better financial outcome than what we're doing by ourselves, that warrants compensation, right? Now, a lot of media buying agencies will want to get compensated based on the amount of ad spend they deploy. Their argument is that, hey, the more we're spending, the more complicated account management is, the more adjustments they have to make. But ad spend doesn't equal profitability. In fact, you can get
Yeah.
into a situation where the more you spend on ads, the less you make in terms of profitability. And I didn't want there to be these conflicting, incentive structures here. I don't want to work with someone who can get paid more by making my client earn less money. So we quite intentionally, structured the agreement so that it was, win-win. It's certainly not the agency's normal way of doing it, but I explained the rationale. I'd put together a model and template so that they could see what we had in mind. I had forecasts going out a year or two so they could see, hey, based on this growth projections and this level of profitability, this is what we think you're going to make. And to be clear, my goal here is to pay them more than what they would normally get paid on an engagement like this, right? If they normally make $7,000 a month, I want to be paying them 10 or 12 grand a month. And the reason for that is I want them to be invested in this. I want this to be their best account. Like, I'm intentionally putting an incentive here for them to prioritize, my client as their client. So, it was really just about, trying to align incentives and get people to act in the best interest of their client.
So one of the other things that we mentioned, or as you were explaining that, was the cash to conversion and just making sure that we have cash coming into the business a lot faster.
Mm-hmm.
And I've spoken with some other guests in the past, some folks that kind of specialize in creating lending solutions for businesses and CPG companies, and that can be also a very challenging space to be in as a business owner. Lenders, the companies that do this are really kind of looking for lending solutions. We talked to some venture capital people on the podcast as well, and one of the things I think is an overarching theme when it comes to finance and lending, things like that, is to not necessarily be dissuaded when you get a no, because you can get a no for a lot of reasons, and it doesn't necessarily even have to be because of your business, and just a lot of reasons why you get a no. But as we are kind of moving into, I think, a different space in 2026, having come through all the tariff chaos that we faced last year, what do you see in this landscape of entrepreneurs and financing and lending options and things like that? Like, some of the things that have been thrown out is like getting a loan on your receivables, right? So what are some ways to navigate through all of that chaos?
Another great question, Ben, but also a very complicated one.
Question with a lot of potential fingers to it.
You did. So, I guess one thing or a couple of things to say off the bat before I give some commentary on, how I see this situation evolving. So the job of a CFO and really what I'm trying to help business owners do is understand risk and reward. Okay. Every decision that you make has a risk and reward profile, and we're not always going to make the correct bets. We'll not always, have the take the right risks. Sometimes we'll lose. But what we need to do is take bets where the odds are skewed in our favor, and we're more likely to win than lose. And if we do that enough and we make enough of these bets and decisions where the odds are stacked in our favor, then statistics and probability says that over time, we should eventually accumulate more wins and losses. The way that this applies to physical products businesses is every time you place a purchase order to buy inventory, you are effectively placing a bet, right? Imagine you're going to the casino. The money that you're putting into inventory is the money that you're putting on the table to place your bet. Now, that's an attractive bet to make, and the owners of these companies make that bet because they're anticipating that they're going to be able to sell the inventory for more than what they paid for it. I put $50 down to buy the box or the widget, whatever. I'm hoping to sell it for 100 and 150. I will therefore net the difference, and that will be my return, right? So there's a return, there's an investment being made, and there's a return coming back to us. The reality is that for a lot of these physical product businesses, the odds are not that, the returns that we're generating are not that high, right? The average EBITDA margin, which is earnings before interest, tax, and depreciation, but the average EBITDA margin for these businesses is like a high single figure number, right? We're talking like 8-9%. So what I'm saying here is that if you sell a product for $100, you're probably doing quite well if you've got $8 or $9 landing in your pocket at the end of the day, right? So it's not like these are crazy odds to be playing. And you have to place that bet a lot of times if you want to create value. You have to place a lot of purchase orders, you have to sell a lot of product, and you have to do that reliably and predictably at a profit if you actually want to build a valuable company. Now, some of the challenges that this industry has faced, and linking back to your question about financing, some of the challenges that this industry faced over the last 4 or 5 years in the COVID to post-COVID era, is that during COVID, there was an abundance of money, right? Interest rates dropped to almost nothing. There was hundreds of these alternative lenders popping up with basically money growing on trees, and they were just throwing it away, throwing it at business owners. It was really easy to get debt. And when you did get the debt, it was fairly cheap. And what that means if you've got cheap and high availability of debt is that you're going to get a lot of people taking bets on inventory. They're going to take that debt, they're going to buy inventory with it, and they're going to try and sell it. Now, on the flip side, when everyone's stuck at home, not being able to go into the office, there was an oversupply.
And the supply chains are shut down.
But there was an oversupply of attention on screens, right? Everyone's looking at their phones, scrolling their social media. When there's an abundance or oversupply of attention and eyeballs, the cost of buying those eyeballs comes down. And people, buying attention and buying clicks got really, really cheap. So what we had is this bizarre environment where the cost of placing the bet was artificially depressed because debt was so cheap. And the cost of basically winning the debt, i.e. paying for someone to come and buy the inventory off you, that was also really cheap. And so we had this really favorable bet that a lot of people were making. And that was essentially what drove the e-commerce boom of the early 2020s. Now, since then, both have moved in the other direction, right? Debt's got more expensive. It's harder to secure. The lenders are more particular about the criteria, and the cost of clicks has gone up significantly, right? So it's now a lot more expensive to buy the inventory, and it's more expensive to move the inventory and get it out of the warehouse than it was before. So on both sides, we've seen this kind of margin compression. And, when you look at multi-year or multi-decade trends in profitability for this industry, it's down and to the right. Like there's been huge amounts of margin compression across this whole industry. And what that's doing now is it's just weaning a lot of people out, right? Like a lot of people are going, you know what? I can't do this anymore. I'm just not making the money that I used to. It's tough, but like navigating this and, helping founders figure out if there's actually a light at the end of the tunnel worth pursuing is essentially what I do for a job. So, there are people around that can help you with it.
It means that as margins decline, you either have to find ways to boost volume, as you kind of did with your other client, the ad agency that we talked about previously, and your cash to conversion cycle, right? That got better. So you find solutions like that, or you find ways to, cut expenses and cut costs in order to kind of extend the runway some when you don't have the volume lift or the margin gain. Um, One of the things I always like to ask people is, when you think about what you guys are doing today, what your company is doing, and kind of focus on the future, what's the one thing going on right now that's really getting you excited about getting up and getting to work in the day?
Wow. I guess from a personal perspective, I am very intrigued by the rate of change of technology and what that's meaning for people to be able to access and afford support, right? Gone are the
Yeah.
days where you needed to pay, five, six, seven, $8,000 a month to get, someone holding your hand and working with you one on one to be a CFO, right? The onus on, consultants, advisors, not just finance people, but like everyone, the onus on us now is to figure out how to use technology to lower the cost of delivering our solutions. And as we get more efficient at delivering those solutions, the number of people that we can, feasibly, economically, and viably help increases exponentially. So historically, like a lot of the smaller businesses have been, just out of reach for most consultants and advisors, right? If you're a small business without a lot of money, not a lot of profit, you can't really afford to get help. But this AI driven, tech tech evolution that we're going through, or revolution that we're all living through now, I just think it's doing some fascinating things in terms of what it's making accessible to smaller and smaller business owners, and the support, service, intelligence, resources that they can now access that they couldn't even just a few years ago is mind blowing.
So I will tell you that a significant portion of the people who reach out to me, they yes, AI generated, reaching out and doing that. I know because I work in these tools all the time, like every
Mm-hmm.
day. I
Mm-hmm.
know they're just like you would know an author when you read a book and you would go, oh,
Mm.
that's that person because I can tell by its tone and cadence and language.
Yeah.
So yeah, I get a lot of inquiries that way. And yeah, I mean, I use those inquiries. I basically take those inquiries and I push them back, and then I say, sounds great. I know there is a vetting I do. Like, I don't just let it freely do it. I go and read through it and make sure, and there's some edits that I make before I send things
Yeah.
out. But if I can get 85% of the heavy lifting done, and it's more of an editorial than a create
Yeah.
from scratch, that's an efficiency for me. And as
Yeah.
you've found, it's an efficiency for you as well.
Yeah.
And I think that's kind of, where we're going. It's interesting that you said these AI bots collaborating with each other. I was literally just watching a YouTube video last night of a gentleman who is literally buying Apple Studio PCs, and he's spinning up these agents that run 24/7, and they even get together and exchange information. And when he launches a new agent, he sends it on a routine to go learn from the other agents and get good at their task, and then
Hmm.
sets them. It is the most incredible thing.
Wow.
And all of this really in the last couple of weeks. I mean, this tech is really fascinating to watch evolve.
Fascinating, but also terrifying. I mean, I don't know about you.
So,
Like,
yeah, terrifying as well. Yeah.
yeah, I mean, I don't know about you. I'm kind of fast forwarding maybe a year or two here. Like, my bot reaches out to your bot, gets me a place on the podcast, but like we've both created AI agents of each other, so we don't even need to show up on the podcast anymore. So you've just got two AI generated bots kind of talking to each other, and the listeners, the people who are downloading it, like, they can probably customize their own content, right? Like, I want to listen to a CFO, but he needs to know a little bit about this and a little bit about that, and I want him to talk about that topic, like, and I've got 37 minutes until I get to work. go. Like, give me a podcast episode that's going to fill
Auto-generate
that
me a
gap.
podcast.
Yeah.
Nate, I think you just hit upon a new thing here because yeah, the AI tech is kind of infiltrating a lot of things. Now, something we didn't talk about and a little background my audience knows about, but I also am a professor. I've been teaching for the past 20 years. And I can tell you, like, this semester, more so than any other, like last
Mm,
semester got crazy with the number of people who were just turning in AI work.
mm-hmm,
But
mm-hmm,
this semester, like, I am spending a significant amount of class time focusing on let's look at what you submitted. Let's run through. Let me pick this apart and tell you why you're using AI. One, I know you're using AI, but two,
mm,
let me tell you why this is not good. And then to quiz people on the content that they've given you. And
mm-hmm.
that's where it just falls apart. And
Yeah.
I think that's one of the cautionary things we need to be aware of is that as we use these
Interesting.
things, is the information right? Yes. But do you know why it's right and where it's wrong? And that's oftentimes where it falls apart.
Yeah, yeah, it's fascinating to think about the long-term burden we're placing on the human brain and what we will and will not need to do and be expected to do in the future. It's just mind-blowing. I'm actually hiring for a financial analyst at the moment, which in and of itself is an interesting decision. Like, should you even be hiring humans to build spreadsheets and models for you in 2026? I don't know, but I am. Like, there's parts of this role at least that I don't currently think an AI can do. But part of the process was I set them all up with a work test, and I sent them an assignment. It said, "All right, you got 3 or 4 hours. I'm not only anticipating that you're going to use AI for part of this. I'm expecting you to." And one of the requirements of submitting this work test is you need to get a screen recording app. And I want a screen recording of what you do for the next 3 or 4 hours. So I actually set it up in a way that I wanted to see how they were going to use AI to do the work because I knew that they would. Like, it's the sort of work that you don't need to do, by hand. So, part of what I was testing is like, how clever can you be with using AI? And I want to see, what tools you use and how you're using them.
That's really clever. I mean, to your point, I work with AI a lot with data.
Mm,
And just recently, I had some sets of data and again, in this CPG space, you probably are familiar working with distributors and things like that. Distributors have data in a lot of different formats.
mm,
And one of the things that is important in the CPG industry when we look at distributor data is we're trying to understand where our sales are coming from, like what products got sold, where did they get sold, things like that.
mm,
Had some data that I was working with all came in a PDF file, which is fine if it wasn't necessarily formatted so great, right? And so
mm,
literally take the files and it used to be you had to go through some like OCR app to convert the text, dropped it into Claude and said, convert this into a table for me. And, seconds later it was done. And
bang.
then
Yeah.
now I can move that data into, another space. And of course you want to go through, you want to make sure that everything's correct. Don't just take it on face value. But, those are the kind of things now these days that one tool, and this is, I think, really where software companies are really kind of shaking in their boots a little bit, is you can have one tool, one very good AI tool that will replace a lot of bits of software. Arguably, you might not even need those bits anymore.
Yeah.
Um, it's the next year and a half or two is just going to be like crazy.
Yeah.
What we're going to see happening in this space.
Yeah. Yeah. Totally. Totally. It's crazy, interesting, fascinating. But I guess I'd love to hear your perspective on this and how you're thinking about responding to it. But I am trying to anticipate what this means for me. What does this mean for me as, a service provider, consultant, coach? Like a lot of what I do can be done better by an AI.
Yeah.
If not already, then very soon. So I'm, for my business at least, quite intentionally trying to focus on the interface between the data and the information and the people. The data and the information is easy to generate and crunch, and probably more accurate if you do it with the computer and AI. But at the end of the day, there's still people making decisions, and people have emotions, they have fears, they have strengths, they have weaknesses, they have certain ways that they like to have things explained to them and be communicated to. So how do I, as a finance centric communicator, manage that interface between the people and the data? And how do I help humans get better relationships with their data? And how do I help humans figure out what questions they should be asking their data? And how does this founder, how are they likely to respond to a certain data set compared to another founder who got exactly the same information, right? What are the struggles and challenges that they're going to have? So yeah, I mean, I could go into more detail, but I think figuring out that like human data interface is probably the last frontier for us humans. It's the last place where I think AI is going to make us obsolete. So I guess for now I'm kind of focused on that and holding on to it as long as I can, I guess.
I think about this a lot. Like what you talked about is, how replaceable am I, and how are things evolving to that space? And there's a couple things where I think we're going to gravitate to. Number one is that we have to remember that these tools are augmentation tools. They're not replacement tools. They're tools that help us get better and be more efficient at things that we know how to do. And
Mm-hmm.
they can't be fully trusted yet. They'll become more and more trustworthy as they go along, but we still need to very much check what the outputs are and be able to explain what the outputs are. The value that people are going to continue to bring to this is just that, is that, well, the machine can generate a response and the machine can give you factual information. It is not necessarily good at the synthesis, at the explaining, at the taking this bit of information here and marrying it with something else more abstract or outside of the box. And what this enables people to do, I believe, is to think in those directions, to spend time thinking and critically thinking about those connections where you didn't really have that time before. And
Mm-hmm.
that in turn is going to help improve the product, it's going to improve the service, it's going to improve what we do, because we're not so buried in trying to figure out something that we now have a tool that can augment some of those tasks for us.
Yeah.
So I see it as like we're going to unleash this new era of creativity and production. But I think where it's going to be difficult are the people who are fighting that, who are resisting it,
Mm-hmm.
who are trying to avoid the realities that are out there. And this stuff is moving quick, and hopefully people keep plugged in and don't. I hate to say be a Luddite, but easily
Yeah.
could be when it comes
Yeah.
to some of this stuff.
Absolutely. Absolutely.
Well, Nate, we're going a little bit over time here, and I know I value the time of my guests, and I definitely don't want to keep you longer than you expect. But before we break away, I would like to make sure that people know where to find you. So, how do they get in touch if they're looking for help?
So, two best ways would be to check out the website, which is futurereadycfo.com. Alternatively, you can find me on socials. LinkedIn is probably the best place. I'm Nate Littlewood, posting pretty much every day on LinkedIn. So expect to see a bit of me if we connect on there. But yeah, they're best way to track me down.
Awesome. Awesome. Well, Nate, thank you so much. I love it. It was a very wise and insightful conversation. I always love that. For folks who have checked out, well, actually, Nate, one other quick thing.
Mm.
You have a podcast as well, do you not?
I do. It's called Profits on Purpose, which is an intentional pun. Essentially, what we're doing is exploring the intersection of purpose-led entrepreneurship and the often sobering realities of needing to be, financially responsible and generate a profit for your business. And what I try to do in that podcast is basically, explore the tension that often exists between those two sets of priorities.
I want to make sure we got that plug in. So if you all are interested, definitely check that out. Everybody, thank you all for checking out This Media Startup Story. I would like to remind you, if you are interested in my book, which is 10 topics to help managers, leaders, and entrepreneurs get better at what they do, please check out my website, benolmos.com, or it can be found on Amazon as well as Barnes & Noble. And as always, like I like to say, share this with a friend, but more, please share it with an enemy, because that will only help us grow faster. We are dedicated to getting to 100,000 subs by the end of 2026 on YouTube. So anything you can do to help us get there is much appreciated. All right, everybody, thank you for checking this out. We'll see you next time, and have a good one. Thanks for listening to Disc Media, a Startup Story. This podcast was produced and edited by Ben Olmos and is a production of Disc Media Corporation. If you're interested in learning more about anything you heard on this episode, please reach out to us at podcast@discmedia.com. You can also get more information about this and other episodes, or information about our guests, by checking out dailypitch.news, our business and insights publication focused on helping managers, leaders, and entrepreneurs get better at what they do.